Let's face it, there are days when we need additional money to surplus our budget or just take care of urgent needs. And the first solution that comes in mind is often borrowing, or simply put, debt. Did you know that there's good debt and bad debt? Of course, you may want to meet your immediate financial needs, but be aware that not all forms of borrowing will have the same financial impact on your life. Whether you choose to take up mortgage loans, payday loans, or purchase things on credit, you must ensure that the debt does not hurt your financial life. Want to learn more about good debt and bad debt? Be sure to watch this video till the end because I'll be showing you the different types of bad and good debt, and most importantly, give you insight in how debt can be beneficial to you. Welcome to ICE, where we teach you the ins and outs of investing, e-commerce, entrepreneurship, and related subjects in between. This is where a community of aspiring people eager to educate themselves come to seek financial knowledge. They are no different from you. So be sure to subscribe to our channel and to turn on your notifications if you want to see more exciting videos like this. What comes to your mind when you hear about debt? Some people will say that you have to get out of debt to attain financial freedom. This is true, but it doesn't mean that getting in debt is a bad thing altogether. Let's first have a look at bad debt. Bad debt. These debts are referred to as bad because they involve borrowing money to purchase rapidly depreciating assets like a car, an iPhone, and the like, only for consumption. Bad debt does little to improve your financial life. Here are 3 forms of bad debt that you must avoid if you want to achieve financial success in your life. Payday loans. A payday loan is a short-term emergency loan that's usually due back in less than a month. Most financial institutions often convince their customers to take up payday loans with a lot of good things promised. But sadly, they don't tell you the other side of the story. This form of debt has the highest interest rates owing to its short-term repayment period. We understand that many people will usually take up payday loans to cater to their emergency needs that cannot wait until they collect their salary. Besides, most payday loans get approved quickly and can offer you up to 50% of your expected salary. But while they may sound like a fair deal, payday loans can end up having more disadvantages on your financial life than you can imagine. Remember, you will always be required to repay the loan within a short time, and if you fail, the high interest rates will keep accumulating. And before you know it, you'll find yourself borrowing a lot more to repay your debts. That's getting into a cycle of bad debts. Instead, you're better off asking a friend or family member to spot you some cash in the short term if you have any emergency needs. Credit card debt. Credit cards are very convenient to use, especially when shopping for things online. But if you're not careful, you can end up in huge debt. Most credit cards have an APR, which stands for annual percentage rate, as high as 27%. This will compound if the debt is not repaid in due time. To avoid getting yourself into credit card debt, you have to, for instance, have a budget. Budgeting will help you to avoid shopping for things that you can't afford. By the way, you can check out our video on why you need to create a budget for your financial needs. See the link in the description. It's funny how many people think having a budget is not necessary to manage their money. A budget is a great tool to help you determine if you're spending too much on a particular category every month. Moreover, it'll also help you plan effectively for your needs at the start of every month. Another thing you want to avoid is impulsive buying if you want to manage your credit card debt. Auto loan debt. This is another form of debt that a lot of people struggle with. One thing I'll tell you is this: don't buy a car yet if you don't have a plan on how you'll pay it back. You'd rather consider creating one immediately. Auto loan debts have high interests and can end up squeezing money out of your pocket every month, especially if you don't repay them quickly. You see, many people think that repaying their car loans in small installments is way cheaper, though it takes a long period. But the truth of the matter is that you'll end up paying more than if you chose to repay the debt within a short time. Also, people forget that when buying a car, they need to take into consideration that the cost of a car consists of way more than the purchase price. Think of aspects such as insurance and maintenance costs. So you better have a car budget in place before choosing to shop for your new or dream car. Are you enjoying this video? Feel free to hit subscribe and like the video if it's your first time here. Let's now see how debt can be good and beneficial. Good debt. In essence, bad debt can also become good debt if it serves a different purpose than covering your consumerist impulses. Yes, if you borrow money to invest in an asset that will keep getting you money in return, then that's good debt. Typically, good debt is defined as money owed for things that can help build wealth or increase income over time, such as mortgages or a business loan. A simple rule about debt is that if it increases your net worth or has future value, it's good debt. And if it doesn't and you don't have the necessary cash to pay for it, it's bad debt. Good debt has the potential to increase your net worth or significantly enhance your life. So, for good debt, prioritize those things that will appreciate and give you more returns. Here are debts that can positively impact your financial life. Mortgage loans, investment mortgages. Whether you're flipping houses or purchasing properties for the sole purpose of renting them out, this can turn into a lucrative way of leveraging debt in your favor. Many financial experts, like Robert Kiyosaki, have hinted before that one can venture into real estate without having a penny. You can take a mortgage loan and choose to add a lease option to the property. For instance, if you choose to lease the property at $1,200 per month and you repay your mortgage loan at $800 per month, you'll be $400 better per month. Now that's good debt. Business investment loans. Business investment is good debt, especially when you're forced to borrow to grow your business. Of course, most businesses often borrow to scale their operations depending on their market share. You can think of a business that sells physical products choosing to borrow from a bank to add to its stock or expand its operations to another city. First, it's very risky to take up a loan to start a brand new business. Almost 1/3 of small businesses failed to survive their first 2 years, shown by a study done by the Small Business Administration. But if you have enough ambition, savvy, and luck, borrowing money to start your own business could be the best investment you'll ever make. Getting a home equity loan or line of credit. You can think of home equity loans and home equity lines of credit as close cousins of a mortgage. This is where you can secure a loan at a comparatively low interest rate using the equity, the value above the mortgage balance, of your house as collateral. A lot of consumers take home equity-based loans to pay off higher interest debts, such as credit cards. On the other hand, some people may use it to make home improvements like solar panels that could save money on utility bills and increase the value of your homes. However, keep in mind that failing to keep up the payments can make you lose your house to foreclosure. Special considerations. Before we wrap it up, it may help if you would understand these special considerations when classifying debt. This is because not all debt can be easily classified as good or bad. It often depends on your own financial situation or other factors. While certain types of debt may be good for some people, some may be bad for others. The first one is borrowing to pay off debt. If you're already in debt, taking out a debt consolidation loan from a bank or other reputable lender can be rewarding. Debt consolidation loans typically have a lower interest rate than most credit cards. As such, they allow you to pay off existing debts and save money on future interest payments. Of most importance, however, is making sure that you use the cash to pay off debts and not to spend it on other things. The second one is borrowing to invest. If you have an account with a brokerage firm, you may have access to a margin account, which allows you to borrow money from the brokerage to buy securities. Buying on margin, as it's commonly known, can make you money if the security goes up in value before you have to pay back the loan. It could also cost you money if the security loses value. Obviously, you should not try this kind of borrowing if you're a novice investor or not ready to lose some money. So, there you have it. You now know the different forms of bad and good debt. On top of that, you're now familiar with hacks you can use to benefit from debt. Feel free to let us know in the comments what you think is the worst type of debt to have and why is this the case. If you enjoyed the video, don't forget to like, share, and subscribe to get more inspiring videos like this. Thanks for watching.